Hello, everyone. I want to discuss two things. My name is Sean Brooks, the Realtor, aka the Real Estate Guy. And what I want to talk to you about is pre approval and pre qualified. Pre approval letters and pre qualified letters. All right, we're going to start with the pre qualified letter first and what it means and what it can do and what it can't do. All right, so a pre qualified letter from a mortgage loan officer or LO. Um, Basically, what it is this: you're gonna reach out to um, you're gonna reach out to the loan officer, and you say you want to buy a house. The loan officer is gonna have a general conversation um, with the person. They're gonna ask you, do you have a job? How much income do you make? Do you have a bank account? What may be in the bank account? Do you have any investment um, accounts? uh, Taxes, have you paid your taxes, etc. Based on, do you have any debts, credit score, maybe. And based on that conversation, they'll say you may qualify. Pay attention to the word may qualify. Okay, that's the criteria for a pre-qualified letter. What can't you do? You can't go shopping for a house. No realtor on the planet should take you out because the pre-qualified letter is not what you need to actually put an offer in on a house. All right, now let's fast forward. Pre-approval letter. Listen to the terms. Approval letter. That means you've been approved. What is the difference? Well, the LO, loan officer, is going to basically ask you those same questions, and then they're going to ask you to send documentation. The documentation that you need to send: 2 to 3 year tax returns. You need to send 2 months of bank statements. You need to send two pay stubs for the month. Get paid twice. You need to send in uh, any retirement accounts that you have, and your credit score needs to be pulled. They will ask for permission to pull your credit score. All right. Now, what they're looking for when they pull your credit score is a FICO score. What is the FICO score? Well, you have three scores. There's three primary agencies that they look for. So the way it works is this: your high score and your low score is put aside. It's that middle score, which is considered the FICO score, that they're going to go by. If you have a qualifying uh, credit score, then you can be approved. They also look for your debts. Is a term called debt to income ratio. What is debt to income ratio? So we'll take your yearly income, right, which you make for the year, and then how many debts do you have, and what is that number? So let's say in a case of you make $100,000, but between car loans, credit cards, student loans, and so on, and then they factor in the debt that you're going to be taking on as far as the mortgage. If that equals higher than a number that they set, like 45% or more, 50%, then your debt to income ratio is too high, and you need to get the debt down to be able to qualify. But let's say you qualify, and now you get a pre-approval letter. They give you a pre-approval letter. The lender will send that to you. When you're working with a realtor, they will send that to you and the realtor. So the realtor knows that we can now go shopping for a house. That is key. All right. Letter may say you can afford to buy a $400,000 house. Doesn't mean that you may spend 400,000, but it says you can qualify up to 400,000. If you have any questions about that, just shoot me a message. I would be delighted to answer your questions individually.